Welcome to another episode of the Capital Playbook. My name is Charles Williams. I am the owner and managing member of Pioneer Realty Capital. And today we have a special program, one that's going to really be interesting, especially if you're financing commercial real estate. We're going to talk about PACE financing. You're going to learn everything there is to know about PACE, hopefully. Well, maybe not everything. You'll learn some things you need to know about PACE. But at the very least, you're going to find it extremely informative. But before we get started today, we want to mention a couple things. We want you to like, subscribe, and share so that we can continue to support this program. And certainly, if you have any questions or comments with regards to this show, be sure and leave that in the comment section. So with that being said, please join me in welcoming Mr. Kris Jones.
Thank you.
Mr. Kris Jones is with PACE Loan Group.
Correct.
Yeah, and we're happy to have you on our show, Kris. Thanks for being here.
Thanks for having me.
Yeah. So, Kris, tell us a little bit about yourself. What you're in commercial real estate. How did you start out in your career?
So, I probably have a more diverse background than most people you talk to in commercial real estate. So, I got started as an analyst for a private office investor in LA.
Okay.
So that was back in the mid 2000s. Mm-hmm. So from there, I got an opportunity to work for a real estate developer, a multifamily real estate developer in San Diego. I came on to do all their project financing. So that role quickly transitioned into all the acquisitions, all the project financing. So that's project financing from construction debt, mezzanine debt, joint venture equity, preferred equity, second trust deeds. We bought about 1,800 units in about 12 months.
Wow.
About $600 million of acquisition value and about $500 million of capitalization. And that was leading into the great financial crisis. So that role came to an end. And then I had an opportunity to be an investment sales broker in Northern California. So that was more institutional in nature. So we were doing office, retail, industrial, Denver West. So it could be a $100 million office tower in San Francisco. It could be a power center in Denver. So I was there for about 6 years. Probably did about $1 billion in transactions per year. Yeah. So it was very active. And then I was presented another opportunity with some of the people I met through that brokerage. They had started commercial real estate crowdfunding company. So they needed someone that knew finance, that knew was comfortable working with owners, operators of real estate. So I came on and expanded the number of sponsors that were coming onto the platform. We were doing 506C offerings, so online syndication, commercial real estate crowdfunding. Did probably about 60 transactions in about 3.5 years. It was great. It was, a time where people were very interested in learning about commercial real estate crowdfunding. More sponsors were using it. More investors were coming on. So it was a period of very big growth for the industry. And then through that, I met PACE Loan Group. And they had an opportunity. They were looking to expand in the Western United States. I'm based in Sacramento. So it made sense. I knew finance, I knew project financing, I knew real estate, and I saw the value of what PACE financing is. There's a unique place for it in a capital stack, and I'm a big believer in how it can be used. So when the opportunity presented itself to expand their presence in the Western United States, it made sense to do that. So now with PACE Loan Group and explaining how owners and operators of real estate can use PACE to complete the capital stack and execute on their projects.
Well, yeah, you certainly have a very diverse background, but it prepared you for really being creative when it comes to structuring and designing a capital stack.
Yes.
And so with your background expertise, all the transactions you've been involved with, you could see where PACE provides value to in a particular deal, or the way it would fit in the capital stack on the deal. So let's talk a little bit about PACE financing. What is PACE financing? How would you define it? If there was a lay person out there just getting into commercial real estate, and you're going to really paint the picture of how this product works, how would you explain that?
Okay, so at a simple level, PACE is property assessed clean energy. The way most people in the industry think about it is that it's for, solar panels and things like that, that are very, widely known energy efficient improvements. But really, the way the programs work across multiple states or across every state where it's available is that It's really to improve upon the overall efficiency of the building. So really anything that's going to touch operating expenses or have a positive impact on operating expenses is likely going to be an eligible expense. So yes, that's solar panels, but it's also windows. It's can be structural in California. It could be storm strengthening in Florida. So there's a wider range of energy efficient improvements than what is commonly thought of. So the way we like to describe it is that if you're building a new building, and you're building to code, then there's likely going to be a whole range of eligible improvements. If you're replacing old components of the building with new building components, then those will likely be eligible expenses. So yes, it's property assessed clean energy, but there's a wide range of what really is eligible for financing for PACE.
So now, so assessment is a part of this this deal. So who does the assessment?
So the assessment's done at the county level. The tax assessor does that assessment. So yes, it's a special assessment on your property tax bill.
Well, I guess when I say assessment, I guess what I meant by evaluating the energy conservation measures associated with that project. Who's assessing or determining if it meets a certain standard in order to qualify for PACE? Who does that?
Sure. So it would be another third-party report that you get in addition to phase one or an appraisal. So it's done by actually an engineer. So an engineer is going to look at your plans and specs. They're going to look at the building code. They're going to look at the legislation in that state. And then they're going to do their calculations of what actually qualifies for financing.
Okay. Now, how much of the project costs in general could PACE financing come in and replace? So if I had let's say a $10 million project, or building this multifamily building, maybe it's 30 units or so. What portion potentially could PACE come in and take of that capital stack?
Now it's going to vary from state to state because each state sets their own legislation as to how their PACE program works. So it's going to be anywhere from 20% on the low end to potentially 35% on the high end, depending on what your scope of work actually is.
Okay. Now, so what is the value of PACE financing or bringing this PACE into the capital stack? How does a developer, if it's new construction or an owner potentially, how do they benefit from PACE being in the capital stack?
So there's a few ways they could benefit depending on how they're setting up their capital stack. Now, if they are raising LP equity, depending on what their senior leverage is, if they're raising LP equity for 40% of the capital stack, so that's going to be more expensive money. So a portion of that LP equity could be replaced by PACE financing at, call it mid fives. So maybe you can replace 25% of that LP equity. So that's going to be definitely accretive to the other LP equity investors. That's one scenario. Another scenario is if they're raising preferred equity or mezzanine financing to complete the capital stack. Their rates 10 to 12%. So if you replace that money with rates of 5.5%, you're definitely benefiting there.
Lowering your cost of the capital stack.
Correct.
Now, when you're working, you have to have a lender in that stack. So if we think about the structure of the capital stack, we would have the equity, in its various forms, right? We would have debt in its various forms, right? And then PACE fits kind of in between those two, right? Now, is PACE senior to the traditional senior lender, or is it junior to that lender?
So it's a little bit more nuanced than that. So there are two components. So the first component is your assessment. So that is the assessment payment. So the annual, semi-annual payment that is owed as a result of that special assessment. That payment, yes, that is senior to the senior lender. The nuance that's often overlooked is that a PACE loan doesn't accelerate upon the event of default. So if we have a $5 million assessment, in addition to call it a $15 million senior loan, and there's a default, that $5 million doesn't come in front of that $15 million. Right. It's only the amount of the payment that's due in front of that senior lender. So that's anywhere from 1% to 3% roughly of the overall value. So that component is senior technically, but not the whole loan amount.
And so that's the issue that banks are having with PACE, because the way they view it, they especially when it comes to permanent financing, because that payment at least is senior to their payment, it kind of messes up the way they put it on the books, right? Because they have to show that there's something in a senior position, or that at least appears to be senior, not necessarily to their loan, but to their payment, right? So what do you think, how are banks getting comfortable with that, or do you see them getting comfortable with that?
Really, banks look at it any number of different ways. There's not one consistent way they look at it. Some banks look at it, they understand it, they like it for various reasons like ESG and the like, and they will consent to a very high loan to cost, a relatively high loan to cost. Other lenders are still getting educated on it and trying to understand it. We've had national public lenders consent to it. So it's really done on a case-by-case basis at the end of the day. It's really going to depend on who the bank is, who the banker is, the borrower and their relationship with the lender. All of that's really going to come into play as to whether a bank is going to consent to the PACE or not.
Okay, so now with some of the PACE loans, let's just use a scenario. Let's suppose that I have a new construction deal, 75% loan to value is my senior debt. The construction lender, are they going to allow you to put that, let's say if the assessment came back or the evaluation came back and said that, well, 20% of the total cost of this project qualifies for PACE. Does that mean that construction lender is going to allow me to put another 20% of PACE debt on top of their 75%? Now essentially have 95%?
That's probably an aggressive scenario.
Okay.
They might allow 10% of it.
Okay.
Yeah, it's going to vary. They're going to look at again the relationship with the borrower, what the specific project is. They're going to look at what they're underwriting the takeout loan to.
Okay.
That's another big factor, especially today.
That is a very important point. So tell the audience why that takeout loan portion is very important, because we talked about that prior to the show. Right.
So we most often see PACE financing being used as bridge equity. So it comes in expected to be out 2 to 3 years as the project's built, stabilized, and then go into a permanent debt. So if the property as it is right now is not underwriting, call it at a 125 coverage ratio, they're stressing the rate to what the today's rate is plus a certain number of basis points. So the challenge is if the property doesn't underwrite to a reasonable takeout loan that takes out both the construction financing and the PACE, then there's going to be some issues.
Right.
It might cause the senior loan to be cut down. It might cause the PACE loan to be cut down. But that takeout loan is especially important in today's market.
Yeah. So and what I've seen is that in that scenario where you have the 75% debt, some of the construction lenders would won't allow you to leverage up to the 90% if you qualify for another 20% PACE, but they will allow you to they'll lower their debt, let's say if it was 75%, maybe to 55%. So you're replacing that portion of the capital stack with cheaper debt, because a construction bridge loan is going to be 8, 9, maybe more percent, right? But if you have PACE in the deal, on a deal they would traditionally go 75% on, maybe they'll lower this 55%, allow PACE to come in at 20%. You're still at 75% leverage, so they don't feel overly exposed. They know they're going to be taken out because there's not too much debt on the deal. But it works out for the borrower because of the fact the borrower has cheaper capital going into that. Now, in a scenario like that, whose cash goes in first? So we have that construction loan at 75%, or let's say 55%. PACE comes in at 20%. Okay. Whose cash is going into that transaction first?
So, of course, the borrower's going in first.
Well, after the equity.
Yeah, after the equity. So a PACE loan is fully funded day one.
Okay.
So the way we look at it is we're trying to get, yes, that loan's fully funded day one, but we're trying to disperse as much as we can at closing, because you're paying the rate on that loan from day one. So if a borrower has deposits out on things like windows, or they've incurred costs related to the project that we can fund that are eligible improvements, then we'll fund that day one. So Ideally, we try to disperse anywhere from 10 to 20% of our loan amount day one, if possible. So you're not paying that negative ARB on that money from the start.
Now, there's no transfer of title. Well, before I get to that question, let me ask you this. Now, the scenarios I presented have all had to do with new construction, because that's where I'm seeing PACE being used most often, either with transitioning properties or with new construction. But what about a property just coming out of construction? Okay, can you go back and retroactively bring PACE into that deal?
Yes, we can. It's going to, again, vary from state to state, but anywhere from 1 to 3 years, we can do, depending on where the state is, what the state's legislation is, where the property is located. It's possible to do, yeah.
Okay, and there's no transfer of title when you're doing a PACE deal?
No transfer of title, no.
Very interesting. So if you have projects, because one of the things that we are seeing because of what's happening with supply chain issues, labor costs, delays in project, there are borrowers out there who are at the end of their construction loan. They no longer have an interest reserve. Still a good project, but they need to recapitalize the project a bit to get them a stabilization. Would PACE be a solution for them?
It definitely would. We actually did a project just like that in December of last year. It was about a $20 million PACE loan on a large tower in Minneapolis. So it was that exact scenario. There were cost overruns. They didn't want to fund it out of equity. So they came in. We retroactively funded $20 million worth of PACE to complete the project. And notably, that was a syndicate of 5 large national and regional banks. Every one of them consented to the PACE in that scenario.
But, because the takeout was going to be there. So yeah. So well, that sounds like a really unique product because what we're seeing now as a result of supply chain issues, labor costs, I think many projects are facing that, and perhaps many don't see PACE as a solution. Some are out trying to raise equity to recapitalize the project. Some are taking expensive bridge debt, maybe unnecessarily, and maybe the real solution is just to go get a PACE loan and retroactively. Now, generally, how long, if you were to do a scenario like that, generally, how long would it take to go from application to funding on a deal like that?
Really, anywhere from 45 to 60 days. It's not an extended period of time by any means. The energy audit, that is probably the quickest third-party report you're going to get. It's anywhere from 7 to 10 days. So the processing timeline for PACE in general is not extended more than a typical loan.
Okay, well, good. Now, PACE has come a long way. And obviously with any product, especially one that's new or to the industry and making its mark in the industry, there are a lot of changes that are happening. What are some of the changes that are occurring with PACE financing that's notable to that borrower or that should be notable to them?
So the big things to note are 2. One is that more states and counties are implementing PACE. Probably the biggest market recently was Washington, where 5 or 6 counties came online for their PACE program. So that's a very early on in the process for that state. So look at your state, look where you're owning property, developing property, and see if there's a PACE program. I'd say the other big change is banks and lenders that are getting educated on PACE, understanding what it is, how the assessment works, and starting to consent to it. And when I say banks, I mean banks of all varieties, lenders of all varieties, large national, international lenders that we've been talking to about certain projects, and they are now open to consenting to it on the right projects. So those are 2 big things to be aware of as it relates to PACE.
Okay, well, good. Now, we know that there are a lot of PACE lenders out there. As with, like there are a lot of banks, but there are unique features to a certain bank that make them different, distinct, and maybe better as it relates to a certain project. Would you say the same would be true with regards to PACE lenders?
Yeah, they all have their niche. Some are specialists just with PACE and only do PACE. Others are doing PACE and ground leases and other kind of unique financing mechanisms. But yeah, there's definitely niches that everyone falls into.
Yeah, so we know there are some that essentially they'll make a PACE loan and they'll create that paper, and then they'll sell it. And then there are those that hold the loans on their balance sheet. What would you say? Is there a better or worse in that scenario? And what would be the advantage of either case?
Yeah, definitely advantages to working with a direct lender. A few reasons for that. One is they have discretion over the capital, so they can price it how they need to price it. Some are keeping it on the balance sheet, others are selling them off. So yeah, they're definitely advantages. The biggest one as a borrower is if you're not working with a direct lender, someone that's going to originate the loan and then sell it off at closing, likely going to run into higher expenses as a result. So understanding what variety of PACE lender you're working with, very important, whether it's a kind of an intermediary or a true direct lender.
So if there were questions that a borrower who's considering PACE, if they were to go into a scenario and to be educated, well, what are some questions they should probably be asking of their PACE lender?
I'd start with ask them if they are going to hold the loan on their balance sheet or are they going to sell it off.
Okay.
I'd ask them how they fund their loans if they're holding them on their balance sheet. Do they have a warehouse line? Who's the lender on that warehouse line? It's pretty simple in this world. It's those two questions will probably give them most of the information they need to vet whether they're working with a direct lender or someone who is ultimately or essentially a broker.
Yeah. And one of the things I always think about, and I'm not saying that brokering transactions is bad, but you really need to understand the quality of the advisor you're working with, and your lender can be your advisor too, because this is not really a complex type loan, but there are things you need to know, and there are ways that lenders can help you, and perhaps even a broker who has access to multiple lenders could help you with, but you want to understand your project, the uniqueness of your project. But I can see the advantages of working with that direct lending source for the simple reason, if there's a problem, you know who to call.
Correct.
Yeah.
Correct. And one thing to add to that is the direct lenders tend to have a better relationship with program administrators across the country. A program administrator is someone that is running the PACE program in that area. So the important thing about that is if we've got a project in, say, Florida, there's some nuances to it, there's some complexities to it. We can call up the program administrator. They know us, we know them. They can tell us how to approach that project to make sure that it's going to qualify in that jurisdiction. That's another aspect of the benefit of working with someone who's a direct lender in this case.
Yeah, excellent. Well, thank you so much, Kris, for being on our show. PACE Loan Group, their information is on our screen. Be sure and reach out to them if you're interested in learning more about PACE financing. I'm sure Kris will be more than happy to walk you through how the program works and how they can help you. But it's been great having you on our show, and love to have you back.
Thanks, Charles.
Whenever you have more information to share about the program.
Thanks so much.
All right. Thank you for being with us.
Appreciate it.